morning, everyone. Let's have a huge round of applause for our panelists because, we couldn't have asked for we couldn't have asked for a better panel, Mr. Sethi, Imran. They have been pioneers in raising domestic capital. For more than a decade and a half, they've been around raising fund after fund. So, let's have a huge round of applause for them. And of course, Vikram, who has been, he's been on the transaction side and, helping these VCs and Ps consummate deals after deals. So let's hear it for Vikram as well. Okay, let me set some context. If we just go by the sheer number of, category 1 AIF in India, you would be surprised there are more than 30,000 AIFs that have been registered with SEBI, of various sizes. And that speaks volumes about how the industry has come about in the last decade and a half. And to that, if Imran, you can take it up first and talk about, how has the growth been for the, domestic pool where, you've raised vintage after vintage. What has the changes been in last 1 decade?
So pretty substantial actually, Sneha. So a lot of you would have looked at the AUM of mutual funds, which is 76 lakh crores. You can see the wealth AUM at 67 lakh crores. Even AIFs are now 12 lakh crores. Number of DMATs and so on. I think those statistics are known to everyone. But broadly speaking, if you look at the financialization of savings, the financialization of savings has been a story since 1991 at least, right? So it's moved from physical assets of real estate and gold, and it's finding its way from bank deposits to public markets and now to AIFs. And this story is playing out. Roughly speaking, the AUMs of a lot of these asset classes that I spoke about are growing at 2 to 3 times the real GDP growth of the country. And I'd say in the last decade, you're right, domestic institutions and domestic capital have stepped up. So you can see, the share of DIIs in public markets. Today, SIPs, as you know, are 23,000 crores a month, which is 4 times the last decadal average of FPI inflows, right? So DIIs have really stepped up. But at the end of the day, why is that happening? That's happening because of a secular trend of financialization of savings. And second, frankly, we should celebrate our entrepreneurs that are creating these opportunities through risk-taking. And it was very fitting, I think, that your second day started with Mr. Pandey's presentation, because SEBI, as an example, and RBI are some of the best institutions in the world. I mean, you could compare them to the US SEC and argue that they are actually one of the best confidence-building institutions. So I'd say entrepreneurship, institutions, and finally the wealth creation on the back of GDP growth has created this. And in many ways, supply is creating demand because we now have products that consumers can trust or investors can trust. That is creating a virtuous cycle for local smart money to come in.
Right. Local smart money, and clearly the UHNIs and the family offices have come of age. Mr. Sethi, if you can, come in and, backstage we were talking about how, you've been instrumental in garnering this entire family offices, the money flow into the AIFs. So what has your experience been, and how do you see this entire asset class growing?
So thank you for inviting me here, and great to be on the panel with friends. I think, and I'll sort of reserve my comments purely for the private markets as such, because that's what we do for a living. I think we're very excited with, India is today in the private markets, which is private equity, VC, direct investments in private companies, at a very pivotal and a very good position right now. And I think the approach being taken with the positive environment created through regulatory affairs, through SEBI, through other organizations in the country and the regulations is we're at a good position, let's do more. I think that's the very positive thing which is today happening. And let me sort of outline the 2 or 3 things which are behind the private market success of AIFs. The first one is it is massively getting scaled. And I think the opportunity here in the next 5 years is perhaps 2 to 3x more. Is 2 to 3x more. Why is it getting scaled? There is a very sound flow of entrepreneurs that is increasing day by day. Very high quality entrepreneurs, number one. I think the other thing is historically, if you look at new companies being formed, and that's very important. What does private market do? Private market enables new companies to be formed which have never existed before. Or similar companies may have existed, but there is a new business model, there is a new technology, there's a new product, there's a new go-to-market. And as such, out of our own company, if I see, which is 60 odd now current companies which are active, the revenue has reached 3 billion. It's scaled. These are VC funded companies who have scaled. Okay. Now, that's the opportunity. Many of these have gone public. Many are going to go public. So effectively, the supply chain to the public markets has increased over the past, I would say, 10 years. And that is going to, again, to my mind, in the next 5 years, you will see nothing less than 20, 30, 40 companies a year, small and big, coming up every year. So there is a supply chain which is instrumental in this. There is a history of success. Of course, there are companies who have not succeeded. Now, looking at this, what are the types of capital flowing in from India? One, as you rightly mentioned, is family offices. Family offices have two trends to it. One, there is a very large trend of mid to larger family offices now institutionalizing. Very fundamental, you'll find many family offices now having CIOs, which as recent as maybe 3-4 years back, I did not find. And I think that's a very good trend overall. As they institutionalize from intuition investing, many of these family offices are going to science-based investing, thesis-based investing, and so on and so forth. That depth is very, very important because that's mature capital, which is now increasing. I think there is also a very high degree of interest in smaller investors. And I have to be very careful that we don't, this is private markets. The illiquidity here is much higher, significantly higher than public markets. We have to be very careful that retail, the true sense of retail does not happen here because these are illiquid assets and they have to be understood as such. But there is interest, and I think the best way to do that is to say many of these smaller investors can come into funds rather than direct. The interest has been through direct so far. I think the larger pools of capital should look at direct because that's larger pools of capital which are needed by larger companies. But the smaller companies, the series seed and series A's, I think is meant for funds because they de-risk the overall investors in the country. So family offices going larger, HNI is getting larger, and the second trend is, of course, as I mentioned, many new funds coming into the picture. These funds are formed by Indian GPs. That's the rise of the Indian GP based here. Not only in seed and Series A, the numbers are higher, but the private equity funds who are Indian GPs we have sitting here as such, they are making a mark in the market space and rubbing shoulders with foreign capital. I must add that foreign capital still is majority as far as Indian private equity and VC is concerned. But if I look at public markets where, domestic capital is rubbing shoulder to shoulder with international capital, I think that day, I hope is not far away, but it needs a lot of work to be done. The third thing, which is a very good trend, is institutions are increasingly participating in PE/VC AIFs.
Well, this is beyond our control, I guess.
Yeah, that's a vote of confidence, I presume. So, SIDBI, SRI, the State Bank of India, you find insurance firms. I think these institutions' participation has given confidence because when they invest, there is a very sound due diligence process, and their pools of capital which they invest in either VCs or some of the larger funds is pretty large. So they can act as anchor. So for many, many years, there was no Indian anchor in VC and private equity funds. I think in the last 3 to 4 years, we are finding Indian anchors, especially for the smaller funds, which is a very big game changer, because looking at them, smaller investors get into a confidence mode. And by the way, even international investors get into a confidence mode, because Indian capital taking risk is a vote of confidence for foreigners to come in and say, hey, you know what, there must be something which I'm missing overall. And the last trend, which is very, very important here, is capital recycling and regeneration. There is, if you look at the last, I would say, 3 years as we've done, there are a lot of secondary funds which have come into the country. Who are they buying out? They're buying out existing investors. Many of them are Indian capital pools, either in the growth funds or in the seed and VC funds. Now that's very, very important. That, I would say, was a very slow process. Exits were itself was a very slow process. We ourselves have returned 900 million to our investors in the last 15 years. But that's a number we had to be worked upon. But most of that was sold to international investors, right? Now that's very important, because when international investors come into secondaries, those companies are mature, diligence is done, and a large pool of that, or some pool of that, comes to domestic investors getting the earnings, the multiples, and recycling back some of that capital back into the private equity and VC market. So I would say these are the 4 trends which are very strong at this moment, and I do see this trend not stopping as such.
Right. It's interesting that Mr. Sudhir spoke about, foreign capital and Indian capital working, shoulder to shoulder in terms of the public market. But when it comes to private market, Vikram, what has your experience been? How is the local capital, the domestic DIIs and the AIF industry really, complementary to the FDI?
So I think, like Mr. Sethi said, right, the domestic capital and the deployment and the increase in the check sizes in the domestic market is in some sense a vote of confidence that the foreign investors are looking at. I think in a very positive way, the domestic pool of capital has made our capital markets resistant to global changes, global political issues. And therefore, earlier we used to speak about exit of FIIs. Now we speak about exit of FIIs, but all those inflows being substituted by the domestic market. So that has kept our capital markets very strong. In fact, in the last couple of years, our capital markets have outperformed most markets globally. What that does is it allows, it facilitates exits. Exits is a huge area of focus for foreign investors. And when they see sort of exits with huge returns in the capital markets in India, that incentivizes them to put in more money. While domestic capital has really grown manifold, I don't think we can substitute domestic capital fully, right? So we need both foreign capital and domestic capital. And in some sense, the sort of increase in deployment of domestic capital in India has therefore incentivized foreign capital as well. So that's really had a complementary effect where both are now, functioning in tandem. Yeah.
Right. And Vikram, will stay with you. And how has, that really impacted deal making? Because you are a transactional lawyer. Yeah. You're right there, you're advising funds, you're advising companies. Yeah. So, you are very much the most essential part of deal making. How has that impacted deal making? Are you seeing any changes where, the prices, valuation, has it impacted valuation given that there's more competition chasing those fewer deals? What are the changes that you're seeing?
Yeah, absolutely. So I think the first point there is that domestic funds and domestic investors are now in a position to write bigger checks. And therefore, whilst buyout deals earlier were dominated by foreign investors, we are now beginning to see that domestic investors are also looking at buyout deals. Now, when a domestic fund or an investor is putting in money, there is a regulatory arbitrage as well. There are certain shortcomings with foreign investors that do not apply to domestic investors, So our economy, our exchange control laws are still quite restrictive when it comes to foreign capital. There are pricing controls, there are restrictions on assured returns, there are lock-ins which hamper exit and so on and so forth. These limitations don't apply to domestic investors. I think that regulatory arbitrage plays pretty well as far as domestic investors are concerned. You are able to structure your exits better. You are able to do quasi-equity instruments. You are able to get some security. You are able to, you're not constrained by pricing mechanisms and hence able to structure your deals better. So that arbitrage has worked in favor of domestic funds. That's point number one. As HNIs and family offices are able to put in more and more money, you now find that they're able to partner with foreign funds as well. So we've done a lot of deals where, let's say, a foreign investor is putting in a sizable amount, a majority, but the balance is partnered with a domestic fund. So we are increasingly seeing foreign investors and domestic pools of capital partnering together. This is all the more in areas where foreign investment is restricted. So for example, pharma. There have been several large deals in pharma where foreign investors and domestic investors have gotten together simply because foreign investors are not able to acquire 100%. And the third area that I would like to sort of point out here is that domestic pool of capital has really incentivized the startup sector. A few years back, startups were looking to re-domicile outside India with the objective of raising capital there. But now with more and more domestic capital available here and with our capital markets outperforming most markets globally, we are seeing that a lot of these startups are re-domiciling back in India, bringing their businesses under India and then therefore eventually looking to list. So I think these are the sort of positive impacts or positive consequences of the growth in the domestic money here.
Right. Talking about the flip side of increasing competition, Imran, do you see, because there are so many funds, competing for the same deal, I'm sure there are instances where, you're competing with your foreign, peers. Has that changed the market where, there's so much money chasing few deals?
Yeah, so first of all, for all the celebration of domestic capital, we must acknowledge that it's 10% of the overall market. So we've grown from 4% to 10% in a short period of time, and I'll be willing to bet that in the next decade we'll be at least a third, right, on a larger scale. So there's substantial growth. So that's point number one. Second, of course, we see competition, but foreign capital tends to come with much larger funds and therefore larger check sizes. So you tend to see them more dominant in, let's say, the $50 million, $100 million check size plus environment. In the 25 to 50 where we play, and I don't know, Sudhir, if that's your experience as well, at the earlier stages, of course, you have some foreign capital, but in the middle, in our experience, it's relatively less, but there is competition. So family offices are stepping up. Early stage venture capital funds have follow-on funds that sometimes compete. We see larger funds that do larger checks. They come early in certain sectors like software, automation, AI, etc. So it's always, I haven't seen an environment in the last 20 years when competitive intensity wasn't an issue to deal with.
Yeah, because we're seeing multi-stage funds getting raised. So I think the mandate is also very flexible these days, even for growth funds, where, they can go in very early and then lapped up with, in subsequent rounds. So in that sense, Mr. Sethi, the very early stage where, you catch them young. We have seen a lot of domestic capital getting raised, seed funds. In that sense, that's one space which is dominated by the domestic capital. What has the experience been with the local capital is ready to do? Because early stage is the most risky one, right?
So I just want to pick up the last point which Imran made. The fact that the exuberance in mathematical terms is 10 to 15% of domestic capital is 10 to 15% is an important point. I think the real question we as an industry have to ask ourselves is, if the gradient of growth has been 30 degrees, can we make it 60 degrees in the next 10 years? By the way, that's critical. Now, of course, to your question, has the seed been dominated by domestic capital? The answer is yes. It also means that domestic capital has a higher potential, higher appetite for risk.
Exactly.
That's very interesting. Out of our portfolio value, 60% value creation is in those companies where no foreign VC has come in. It's a very important, and that's for us. I do not know the other parts of the industry in terms of mathematics, but I think it's an important point as such. So the real question is that if domestic capital has to come in more, right, what's the criteria for that? I think the first criteria is very simple: performance. There's no question about it. Performance in IRR terms, performance in capital return terms. The larger firms, who've been around for, let's say, 10 plus years, have started to return DPI in a very, very big manner as such. That is crucial. It's very exciting to do investing. It's a very tough job to do divesting, right? Very tough job. I've seen many people who are excited about investing. The moment you say do an exit, it's like, really? Are you asking me to do an exit? That's like, why are you asking me to do investing? In professional, I'm saying. Firms are today, who have been around for 10 years, we've been around for 18 years, I think we've had to develop, and please add to that, develop a culture of exit, right? There is a movement from a culture of investing to a culture of exit as such. And trust me, culture of exit, secondaries. When your fund is doing end of life, what do you do? It's a different world out there. You have 1 year to exit, 1 year in fund of life exit. What do you do? Number of M&As in the country. Are Indian companies buying Indian companies or not? Is IPO a big issue? How do you take a company to public? I think that is a very, very big thing. Of course, I think the risk patterns in the early stage are higher. We have to think about how to get more capital there up to the mid stage. I would say natural tendency for Indian capital to come to larger funds would be better, for the simple reason that the risk to reward ratio or risk to safety ratio is somewhat better. The risk is higher in seed and Series A. Now I will take back to what was done by the industry to promote software industry. There were STPIs. There were certain benefits which came in at some point of time. To encourage manufacturing, there is PLIs. I would even encourage our industry to think about saying, what is to be done to catalyze the domestic flow of growth, especially to the early stage, because the risk patterns are higher. On similar lines, when we thought about how software industry grew and in the early 10 years or so, or PLIs in the system as such, my sense is something of that sort may be a trigger, because very clearly the industry is growing. There is no question about it. The question is, can we take it 3x in the next 10 years or maybe lower?
Sneha, I just want to follow up Sudhir, excellent points, because these two things, which is exits and performance. Uday Kotak is going to speak later this evening, and if you speak to experienced bankers, they say, look, lending is about collections. They're very clear. Lending is about collecting, right?
Absolutely.
And if you translate that into our business, investing is about DPI. It's about exit. So you're bang on, Sudhir. And that's, by the way, the big headline. The silver lining of India's private equity venture capital story over the last 20 years is the exit track record over the last 5 years. I think that's been the game changer.
Right.
The second point I want to make is on performance. I want to build the case that it's very important that funds benchmark themselves to global dollar returns. The fact of the matter is that US has been a spectacular market, both in public markets that returned 25% CAGR over the last 2 years, 25% in dollar terms, okay? And private markets, even if you adjust for leverage, which we are not allowed in India, has been spectacular. Right. So if you want to raise capital from sophisticated institutions in India, ultra HNIs, HNIs. Remember the awareness now, you have sophisticated family offices who have global portfolios and they are looking at dollar returns.
Right.
So it's not enough to celebrate your rupee returns anymore. You need to deliver DPI and you need to cross a certain benchmark in dollar terms. And I think that's healthy. We saw that in IT and pharma. We've got a $250 billion IT services industry because it was, we were trained on working with Fortune 500, Fortune 1000 companies. So I think that's very healthy in our industry.
Right. And with this culture of exits that they talk about, we've seen a lot of, money getting recycled where family offices have come back, HNIs have come back with larger checks. Vikram, if you can talk about, we've also seen the ecosystem really develop, the regulatory changes that have come about to really support this entire, channeling of, UHNIs, HNI money into this asset class. So how have you seen the regulatory change over the last 10 years?
Yeah. So I think from a regulatory standpoint, the changes have been very supportive of domestic money coming into some of these private sectors. But I think more can be done. So for example, in AIFs, you have a minimum check size of 1 crore. For angel funds, it's 25 lakhs, right? So maybe some reforms in that area which can mobilize more savings into private investments, right? I think the SEBI chairman also spoke about that some time back. I think today there is some shift in savings into into the non-conventional sectors, away from real estate and gold and all of that. But most of that is in the public markets, in mutual funds. Even that is roughly, I think, 3.5–4% of total household savings, right? So maybe some reforms there which can move these savings into the private markets. That's one change that could be welcome. The other is, domestic money can also, at least from large corporates, be effectively used and deployed and invested outside India. Currently, there are some restrictions and limitations there. Companies can't invest beyond a certain net percentage of their net worth outside. AIFs are restricted from investing more than 25% of their corpus outside. So if those can, there can be some flexibility there. It will further help, in investing domestic money outside.
Right.
Can I just add to that?
Yeah, sure.
The trigger points I mentioned on the software industry and the electronic industry, there are two, and I'm sticking myself to private markets right now. One is to get the 2 to 10 crore investor to 15 crores. That may seem 50%, but it's important. But let's take care of the fact that there is a large number of family offices who can write checks at 100 crores and 50 crores and 200 and 300 crores. We've seen that ourselves. We've been backed by local capital to the extent of 4,500 crores in the last 10 years.
Right.
Okay? That's about 40% of our total capital raised. Now, if I look at that, the larger pools of capital obviously will be larger chunks and not the smaller chunks. I think it's interesting to think about it, that is there a trigger required for somebody who invests from family offices or institutions at, let's say, 100, 200, 300 crores into funds or direct? I'll stick to funds for a little minute because I think the tendency to go to direct is very easy overall. And what is that trigger? What is that trigger? If I take the two examples of software industry and manufacturing PLIs, let me, for a lack of any other word, call it capital PLI. Okay? Can we think of those trigger points which are important? Just to give you an example, we did a little bit of homework pre-COVID, and the top 5 IT companies at that point of time in a 5-year period had spent on share buybacks and dividends over $30 billion in 5 years. Okay? I'm not saying that should not happen. All I'm saying is there is a huge amount of capital lying in reserves in corporates. Now, is that being capitalized into, let's say, growth patterns or M&A? I would have thought it would. But I think it's important to think where these pools of capital are and how can we mobilize through triggers which will grow 3x in 5 years, right? Assuming that there is a absorption capacity in the industry, which I truly believe there is an absorption capital in the industry.
Right. One last question to Imran. How far are we from $1 billion, domestic fund? When do we see that happening?
The short answer is I'll be very surprised if it doesn't happen in the next 7 years.
Okay.
But I'll tell you how. And Sudhir mentioned a few ideas. If you just take the ultra high net worth pool of capital, there are estimates of $2 trillion by 27. If you assume a 40% savings rate and their allocation to AIFs or alternatives go from 7 to 8% to 15%, that's $100+ billion waiting, looking for ideas.
Right.
Right? I'm not even counting insurance companies, pension funds, corporates. I'll be very surprised if you don't have that in the next 5 to 7 years. But there is a cautionary message also.
Okay.
We must not, as an industry, get caught into the vanity metrics of AUM. We must remember that we are fiduciaries first. And so the point of, generating risk-adjusted returns that are globally benchmarked, to be truly the custodian of investors, big or small, I think is the most important growing up that the industry needs to do. I'm not saying we're not doing it, but that will then earn the industry the right to do what all of us are saying should be the path from 10% to 30 to 40% of the industry.
Right.
Can I change that question?
Okay.
I think the right question is for a VC.
Right.
I think the growth funds have possibly achieved that. When is a VC going to return $1 billion from one of its funds?
Right.
Then the $1 billion fund is an easy task, right? Because when you raise $300 million, right, you have to return, if you take a 3x net in dollar terms, or 3.5 GRES, you have to return $1 billion. Trust me, it is a science to do that, right? And if that is done, and to my mind, I don't think it's far away for maybe a few of the Indian VCs and certainly for the international VCs from India.
Right. So I think we've run out of time, and it was such a fantastic, discussion. To sum it up, they are the fiduciaries of investors, and we are not far from seeing $1 billion funds being raised in India by local investors.